Hello everyone. What we're going to do today is take a practice question from the non-current liabilities questions that are posted. Primarily the focus is going to be on question number ICQ number 8, which is AP 1005 from the textbook. This is the particular question, so take a moment, have a look at it. I would suggest you pull this down from the portal so that you have it in front of you and can refer to it as we work through it. I will be doing the solution in Excel, or in particular I'm going to be using Google Sheets, and then I will post a link to the solution as we've worked through it onto the portal for you to refer to. I'll try and do this in a couple different videos, so primarily focusing on pricing of the bond and also the entries in question number 1 and 2 to begin with, and then we'll try and do a separate video, and the focus of that video is going to be on what you do when you either redeem the bonds or at the end of the term of the bond, so that you have a couple different videos to refer to depending on what you're working on. So we'll get right into the question. Again, I would suggest that you go into or have the question in front of you so that you are able to refer to it as you work through the question with me. So right off the bat, the way I'd like to do these questions when there's a lot of information is to summarize the information that you get in the question. So Ashraf Limited sold on June 30th, 2017, 4 million 20-year bonds. So you know right away, face amount, and then you write that down. So face amount, 4 million. Then you know that it's a 20-year bond, so term 20 years. Then it says paying a nominal interest rate of 6.5%. So this is your stated rate of 6.5%. Then the bonds were issued at 105.7344% with a yield of 6%. So when you get a number like that where it says 105 with decimals, what that's telling you is that this bond has a premium. So premium 105.7344. Now this number is relevant, but I will show you the mechanics of how to calculate it the way we've discussed during lecture. And then after that, I will show you why this number becomes relevant. So premium, and the market rate is 6%. Right, 5, yeah. All right, 6%. Okay, computer's misbehaving a little bit here. So try that again. 6%. All right, there we go. Try to make this a little bit bigger for you guys so you can see it a little bit better. Okay, so the bonds pay annual interest on June 30th. So that's important because the examples we looked at in class were semi-annual, so twice a year. This is annual, so that means only one interest payment every single year. All right, so we know that it's annual, so we'll write that down. And then we know that it's June 30th is when they pay. And that's important to know. So the company uses effective interest rate method, which is generally the default, and a reminder that that is the preferred method under IFRS. So you want to keep that in mind. And what's the last piece of information here? Year end is December 30th. So December 30th. Okay, so what does question number 1 ask us to do? So question number says is prepare the journal entry to record the issuance on the bond. So JE on issuance. Okay, so JE on issuance. So this is fairly straightforward, and we've looked at examples like this in class. The way you do this is present value of the principal, which is step number 1. So in this case, our face amount is $4 million, and we want to present value that. So it's going to be $4 million. 1, 2, 3, 4, 5, 6. and then use the present value table to get your rate. And in this case, our rate is 3118, so 0.3118. And how do we get that? We know it's 20 periods. And remember that it's annual, so it stays at 20. If this was semi-annual, so twice a year, this would have been 40. So we know our rate is 20, and we look at the market rate when we're looking at the table. So 6% market rate. If we were to go back to our time value of money tables, and this would be table number 1 because this is present value of a single payment and not an annuity. Okay, so single payment, 6%, 20 periods, we go all the way down, 3118. All right, so we go back to our present value principal. This is 4 million times 3118. So the second thing we need to present value is the interest. So present value of interest is, so you start with the face amount, $4 million, times the stated interest rate, 6.5%, 0.65, times the factor. And again, we'd go back to the present value tables with our N, so number of periods being 20. And our interest rate, again, use the market rate when you use the tables, use 6%. In this case, we're using the second table, which is a present value of annuity table. So 6%, 20 periods, and you should have these tables in front of you because they're probably very, very small in the video. So it's 11.4699. So we go back to our example and 11.4699. All right. So now you've got 298.2174. So the price of the bond will be the total of these two numbers, which is 4229374. So it asks for the journal entries on the issuance of the bond. So we know when you issue a bond, you'll debit cash because cash is coming in, and we know we're going to credit the bond payable. Now the way to start this entry would be you start with the bond payable because you know that the initial liability has to equal the face amount of the bond. So go ahead and you put in your $4 million credit. Now you know when you debited cash, the cash when you sold the bond is the cash you are receiving. So when you sold the bond, you are going to get this amount of cash because this is what your bond was priced at. Right? So it's 4229374. Okay? Which means that you need an amount to balance the entry, and that amount is going to be the premium. So debit premium on bond. Let's get the spelling right there. So premium on bond, and it's the difference between the two numbers. So if you were to look at that, since it's a negative, we're going to do it that way. And the difference between the two numbers is 229,374. So we make sure that's a negative, so just fix the formula there. Okay, and the way to check that you got your entry right is obviously to add them up, and you'll notice when you add these up that your total is 0. That means you have a balanced entry. All right, wonderful. So now if we look back and we come back to that initial piece, we said that this premium amount of 105.7344, we are not using it. But if you were to try and use it, you could use it to double check that your answer is correct. So if we were to do a premium check or a proof, what you would do is you take the 4 million times the 105.7344, which is a premium percentage, and you calculate that. And we probably should have done a decimal there because that's a percentage. So we'll type it in manually, 105.7344 7344 percent, and that gives you 4229376. 4229376, 4229374. That's almost the same. We used an exact number. This is a rounded number to 4 decimal places. So we're a couple dollars off, and that's okay. So at least we know that our calculation using the present value tables was correct. Okay, so we'll stop the video there and then continue on in the next video with the journal entries on how the liability is presented and other journal entries after the first interest payment.